Hello, my name is Andre Garcia. I'm with the Growth Capital Company and Innovative Mortgage Finance. In today's video, my NMLS number, by the way, 2246130. Although, because of the compliance concerns, we won't be talking about pricing today. But what we will be discussing is 5 different ways that you can get a mortgage without tax returns. If for whatever reason you don't have or you don't want to show tax returns, then there are alternative documentation methods that you can take advantage of in order to get a mortgage without showing tax returns. Okay. Now, right up front, this isn't something that I'm necessarily encouraging. Okay. This should be a worst case scenario. My job is to get you approved. My preference is to get you the best terms possible. So, of course, if you don't have tax returns or if it's just they can't be used, fine, let's do a no tax return mortgage. But if it's just that, it's annoying to get them or you don't know where they are or if it's one of those sorts of things, we can fix that. I'll call the IRS for you. All right. I'll do all the legwork. I will hunt down your tax returns if you're having trouble finding them. There is no problem that you can put me in front of that I cannot resolve. So give me a shot first before, we pay more than we have to. But if it's a legitimate case, tax returns are not available. We cannot go full documentation. We can't go conforming. We're looking at alternative documentation methods. There are multiple ways that you can that you can get a mortgage. Okay. Now, normally required is going to be a little bit more money down. So a 3% down mortgage combined with these things is unlikely. As far as LTV, I think we're looking at about a max of 90%, roughly. Okay, 90%. I might be able to find something with a higher CLTV, but as of right now, the highest LTV, 90%. That means that you have to put 10% down. They're not numbered because I'm not saying that one is better than another. This is just a conversation about alternative documentation methods that are available in the mortgage industry that you can take advantage of if for whatever reason you cannot show tax returns. So, bank statements, 12 to 36 months. Now, what's the most typical is 12 or 24 months. There are there's a few sources out there that go out to 36 months. In a perfect world, I would have 36 months worth of bank statements, and then we can sort of use whatever is going to paint you in the best light. We can run the number. I would be able to run the numbers as far as qualifying you based on 12 months, 24 months, and 36 months. Price it out and see what way is going to be the most advantageous to you. Bank statements can be personal bank statements. It can be business bank statements. We can use multiple sets of bank statements. I mean, whatever it takes in order to get it done. So we can use a combination of the different banks that you use for yourself and for your business. And we can use that to calculate your real income. And based off of that, we can secure an approval. You would not have to show tax returns, just bank statements. And then, of course, some of the other supporting documentation, but bank statements. As far as POI or proof of income, bank statements, done. Another way, 1099 and a profit and loss. Again, a lot of these issues with tax returns are often going to come up with people who are self-employed business owners who have more complex tax situations. So we have several investors that will fund your mortgage with a 1099 and a profit and loss statement. Profit and loss statement not necessary, but again, mortgages are pricing on mortgages is about reducing risk. Okay, the more we are able to reduce the risk, the better the terms that we are going to get. Documentation is one of the primary ways that lenders use to increase or decrease risk. Documentation, it's one of the primary methods. So if you can prove your income, if you say that you're making this much and you can prove it, it's going to be better. The stronger the proof, the lower the perceived risk from the lender's perspective, and that is going to directly correlate with the cost of the loan. Okay. But so yes, 1099 and a profit and loss. Not necessary, but it's just a document. You fill it out. I even have, if you go on the growthcapital.company, you go to the portal. If you don't have one prepared, there's one that you just answer a few questions and we will prepare the profit and loss for you. Okay, so nice and easy, lower stress, and saves a lot of time. Next, asset depletion. Okay, so asset depletion is when you have a lot of liquid assets, money in the bank, cryptocurrencies. If you have high value assets that are worth, money, so stocks, bonds, 401k, you have a lot of money in the bank. You have a lot of assets. You have a lot of liquid assets, but you don't have any income coming in. You can't go conventional, because if you don't have income coming in and you're trying to get a mortgage, even though you could have, however much money in the bank, you could have $10 million in the bank and you're looking for a $300,000 loan. If you don't have income coming in, you're not going to be able to go conventional. Of course, you can pay cash, but you're not going to be able to get a conventional mortgage. So if you, for whatever reason, you want a mortgage, asset depletion is when they look at your liquid assets, and as long as you have a certain amount of months available in liquid assets, and what I mean months in terms of your monthly payment. So if your monthly payment is $2,000 a month, they might want you to have 3 years worth in the bank at least, or 5 years worth in the bank at least. Every lender is a little bit different. I feel like this scenario, it could come up in many different ways, but retirees, recent retirees, that's what I imagine, at least. A recent retiree, 401k hasn't kicked in, they went from making a lot of money to a little bit of money. They want a home that reflects the way that they want to live. But if their income has been drastically cut, but they have millions of dollars in the bank, there's scenarios like that, a recent decrease in income or unsteady income. There could be, if you have money in the bank, if you have a lot of liquid assets and you want a mortgage, you have, 3 or 4 or 5 years worth of monthly payments in the bank. Asset depletion is a way to get a mortgage. You would not need to provide any tax returns whatsoever. So that's another way. Now, this next one is really more for real estate investors, because the DSCR, that stands for debt service coverage ratio. The short story is how much are you collecting in rent and how much is the mortgage payment. If you're collecting, if your mortgage payment is $1,000 a month and you're collecting $1,250, then you have a 1.25 debt service coverage ratio. Of course, not available for primary residences, because you're not paying rent to yourself. So if the real estate is for business purposes, there are programs available where you do not have to show any tax returns whatsoever. It's just based on the amount that the property is collecting in rent. And as long as it's over a certain threshold, then you could very well get approved for that mortgage without showing any tax returns. This last one, again, sort of a unique, well, not unique, but it may not apply to you. This is a third-party letter. So this situation is going to come up with foreign nationals. If we have a developer from India or China, or a doctor from Cuba, or anywhere in the world, really. We have people from all over the world that come to the United States to study, and then they end up staying, and whatever. So a third-party letter. If you're either just graduating college, or if you're new to the country and you're coming here to work, you want to buy a house, but you don't have but you don't have any tax returns because you just got here or whatever, and you have money to put down. So the third party letter, essentially your employment letter. So if you have a concrete job offer that states your income, that states what they're going to be paying you as far as income is concerned, then I would be able to use that letter from your future employer to use to calculate debt to incomes and all those things. Now, the letter, you can't just give me whatever letter that your buddy writes in crayon, because it is something that is called and verified. All right, we take this very seriously. Okay, so so that's 5 different ways, in no particular order. Certain different alternative documentation methods are going to apply to different situations. So if you have a particular situation and you don't have tax returns, or if your credit's not perfect, or any of these sorts of potentially what some people perceive as tricky situations, but it's situations that I love because I like challenges, and there's no problem that I cannot solve. No problem that I cannot solve. I'm a wrecking ball, and I'm here to fight for you. So yes, please, you can visit me at growthcapital.company. You can reach out to me, through the variety of methods. I prefer the website because that way I get to learn a little bit more about your particular scenario. And if you need help with anything, I'm happy to answer any questions. All right. Andre Garcia with the Growth Capital Company checking out. Thank you very much.